Welcome to today's Explainer, where we're putting on our trench coats and acting as financial detectives to uncover the truth hidden deep inside corporate accounting. Whether you're analyzing a potential investment, doing a little recon on a competitor, or just trying to get a read on the actual health of a business, the numbers always tell a story. But you gotta know how to read them first. Just like Cuba Gooding Jr. was screaming in Jerry Maguire, financial statements exist to do exactly that: show you the money. They literally map out exactly where a company's cash is coming from, where it's going, and where it's sitting right at this very second. Without these documents, we're basically just guessing in the dark. But with them, we've got a treasure map. All right, let's take a quick look at our investigative roadmap for today. We're covering 1. The big three statements, 2. Profit versus actual cash, 3. Standardizing with common size, 4. Crucial footnotes and ratios, and 5. Spotting financial red flags. Let's get into it.
Section 1. The big three statements, the scene of the fact.
First up is the balance sheet. Think of this as a freeze frame, a literal snapshot in time of the business. It's built entirely on one fundamental, non-negotiable equation: assets equal liabilities plus shareholders' equity. It basically balances what a company owns, so cash, inventory, heavy machinery, against what it owes to the bank or suppliers, plus that leftover value that actually belongs to the owners.
Next up, the income statement. I absolutely love the SEC's metaphor for this one. They describe it as a set of stairs. You start at the very top landing with gross revenues, right? That's all the money rolling in from sales. Then you just walk down one step at a time. Deduct the costs of producing the goods. Boom, you've got your gross profit. Step down again, deduct those operating expenses like marketing and salaries. Step down once more for taxes and interest until you finally hit the floor, the literal bottom line, or net profit. And rounding out the big three is the cash flow statement. Because while the income statement tells you if you made a profit on paper, the cash flow statement shows you the actual hard cash moving around. It groups everything into three buckets: operating activities, which is cash from your daily grind; investing activities, like buying a new warehouse; and financing activities, like taking out a loan or paying dividends. As a detective, you really want to see that first bucket, operating activities, absolutely overflowing. That proves the core business is a cash-generating machine. Which brings us to Section 2, profit versus actual cash, the magnifying glass. So let's grab that magnifying glass and clear up something that trips up so many people. Why does reporting a massive profit not mean a company actually has any cash in the bank? It all comes down to accrual accounting. This means revenue is recorded the second it's earned, not when the cash actually hits your account. So you sell a ton of product on credit today. Your net income shoots up instantly. But wait, that customer might not pay you for 60 days. Cash flow, on the other hand, only cares about actual physical dollars crossing the threshold. So how do we bridge that gap? By taking net income and adjusting for all that non-cash stuff, we can reconcile our way to the true operating cash flow. Let's look at this example. We start with 100 grand in net income. We add back 15 grand in depreciation because, hey, depreciation is just paper wear and tear, no actual cash left the building. Then we subtract 10 grand in accounts receivable since customers still owe us that money. Finally, we add 5 grand in accounts payable because we held on to our own cash by paying our suppliers a little late. The end result? That $100,000 profit actually generated $110,000 in pure, cold, hard operating cash flow. Moving right along to Section 3, standardizing with common size, the universal translator. Okay, if you're trying to compare a massive global titan to a scrappy regional competitor, raw numbers are absolutely useless. Look at company Y here: 10 million in sales, 1.5 million in operating profit. Then you have company Z, much smaller, just 2 million in sales and 400 grand in profit. At first glance, company Y looks like the absolute powerhouse, right? But are they really the better, more efficient business? Well, watch what happens when we use our universal translator. By dividing those raw profit figures by their total sales, we create a common size percentage, and the story totally flips. Company Y has an operating margin of 15%, but company Z, they're rocking a 20% margin. That means for every $100 company Z sells, they are pocketing $5 more than their giant competitor. They are way more efficient.
Standardizing financial statements into these vertical percentages lets us completely ignore raw size and instantly spot a company's underlying strategy. Like if you see a company with crazy high gross margins but massive R&D expenses as a percentage of sales, you immediately know their playbook. They are betting the farm on cutting-edge tech. A competitor with lower margins but zero R&D is likely just competing on price. The percentages don't lie. They reveal the whole game plan.
Let's dig a little deeper with Section 4, Crucial Footnotes and Ratios, reading between the lines.
Fun fact for you, there is actually a racehorse named Read the Footnotes that ran in the 2004 Kentucky Derby. He finished 7th, but honestly, his name is fantastic advice. A good detective always reads the fine print. The footnotes and the management's discussion and analysis, the MDA, provide absolutely crucial context. This is where they admit how they account for inventory, if their pension plan is massively underfunded, or what hidden risks keep the CEO up at night. If you skip this part, you are flying completely blind. And once you've got the full picture from those footnotes, you can start firing off these key financial ratios. Divide stock price by earnings to get your PE ratio. That tells you how expensive the stock really is. Check out debt to equity to make sure they aren't dangerously over-leveraged. Look at inventory turnover to see how fast stuff is flying off their warehouse shelves, or run a quick working capital check just to make sure they can actually keep the lights on for the next 12 months. Which leads us to our final act today, Section 5, Spotting Financial Red Flags, Catching the Culprit. Because here's the million-dollar question. What if the numbers are actually lying to you? We always have to ask ourselves if the pristine financial statements we're looking at are masking a much uglier truth. Believe it or not, even audited statements can obscure operational decay or really push the boundaries of what's allowed. If you aren't vigilant, these illusions can totally wipe you out. According to the experts in our sources, there are 2 massive red flags you need to hunt for. First, consistent margin compression. If sales are going to the moon, but margins are shrinking year after year, that screams operational failure or a brutal loss of pricing power. The second major warning sign? Creative accounting. If you're reading those footnotes and suddenly notice they've changed how they recognize revenue, like logging sales way earlier than they used to, that's often a desperate attempt to manipulate GAAP standards and artificially inflate their numbers. So, you've got the toolkit now. You understand how the big 3 statements lock together. You know how to strip away the noise to find the real operating cash flow, and you can standardize the data to compare literally anyone against anyone. But having the tools is only half the battle. The numbers are always talking, always telling a story beneath the surface. The only question left is, whose financial secrets are you going to uncover first? Thanks for joining me for this explainer, and happy sleuthing.